Crypto is officially in the early stages of euphoria. And how awesome does it feel? Crypto sentiment is overwhelmingly positive, and why wouldn't it be?
Well, why not?
Why not?
Pretty much everyone is in profit. And the best part? We're only just getting started. And this was backed up by a recently released crypto report, which shows just how early we still are. Today we'll break down this report for you in simple terms and tell you what this could all mean for the crypto market. Stay tuned. Now, the report we'll be summarizing today is titled, quote, Digital Asset Report, Institutional Perspective. It was recently published by Glassnode and Fasanara Digital. We'll leave a link to the full report in the description for you if you want to check it out in full. A fair warning though, it was written right before BTC went on the rampage to new all-time highs, so not all the information will be applicable today. It's just one of those things, folks. Crypto moves very fast after all. In any case, we'll be giving you the key highlights in today's video. Anyway, the report starts with a look at how the crypto market has been performing as a whole, starting with the two largest cryptos, BTC and ETH. The authors note that since FTX spectacularly collapsed way back in 2022, the market has recovered very well, and this is an understatement for BTC, which had gained 372% at the time of the report's publication. And it's been running on rocket fuel ever since. As you'll know, this is largely thanks to the spot Bitcoin ETFs, which have encouraged institutional investors to enter the space in a more regulated fashion. As for Ethereum and the wider crypto market, things have recovered in a similar fashion, albeit not in quite a dramatic way to BTC. In that same period, ETH recovered 137%, slightly underperforming the broader altcoin market, which gained 158%. Naturally, this is because BTC dominance has remained very high, and new retail has yet to arrive and explore the broader crypto market. To back this up, the report uses on-chain data to assess the capital rotation in crypto. The chart provided clearly shows that in the last cycle, investors would allocate most of their capital to BTC and then rotate to alts and stablecoins once BTC hit its peak. However, because of the lack of retail in this cycle, not much capital has shifted away from BTC, so far anyway. Now, the next part of the report zooms in on the spot market. The authors highlight that trading volume on centralized exchanges peaked when BTC hit its March all-time high, but have been steadily climbing since May. In fact, trading volume on CEXs have been consistently climbing since October 2023, showing that investors have been positioning themselves without really moving the market. The authors then use a metric called CVD, which stands for Cumulative Volume Delta. To keep things simple, the CVD metric basically measures sell pressure. And as it so happens, sell pressure has remained strong since BTC's March high. But this has less to do with price speculation and more to do with the supply shocks we saw earlier in the year, like Mt. Gox distributions or the German government selling nearly 50,000 BTC. It's crazy how BTC's parabolic rally can make even recent events feel like a distant memory, eh? The authors then turn their attention to Bitcoin's derivatives market, which have grown a lot in recent years. We won't go over everything here for the sake of time, but there are a few key takeaways. The first is that the practice of using crypto as collateral for a 100x leveraged futures position is becoming far less common. Instead, more futures traders are using USD-backed stablecoins, which has changed the dynamics of the crypto market, but that's a topic for another time. Now, on top of this, the authors point out that following the approval of the spot Bitcoin ETFs earlier this year, we saw a wave of leveraged traders getting liquidated in either direction, especially after BTC's peak in March. However, the amount of liquidations since then has actually been on the decline. And this means that BTC's current rally should have a fairly smooth ride ahead. Not many crazy liquidations, at least for now. The authors then look at the size of the borrowing and lending market, which they estimate to be roughly the same across both CeFi and DeFi platforms. They note that thanks to various restaking incentives, there's been a steady increase in the amount of borrowed crypto since March. Stablecoins made up around 1/3 of the demand here, whereas ETH and other tokens made up the remaining 2/3. And this makes sense when you consider that most of this activity would have been happening on Lido Finance, which supports liquid staked ETH. And by the way, if you're enjoying this video so far, then let it be known. Give that like button a boost and don't forget to subscribe and ping the bell notifications as well so you don't miss our next video. The next part of the report takes a look at the US spot Bitcoin ETFs, which you'll know were approved back in January and opened the floodgates to traditional and institutional investors everywhere. According to the report, the ETFs now hold roughly 5% of BTC's supply, which some would argue is more of a net negative than a positive. As bullish as the ETFs have been, some Bitcoin purists believe that BTC's concentration in traditional financial vehicles goes against its core ethos as an alternative to the legacy financial system. Anywho, the authors note that whilst BTC was chopping sideways since March, ETF volumes were consistently between 1 billion and 2 billion per day. But this began to spike as BTC went on its mission to the moon. According to the report, the average price that ETF investors accumulated BTC was around 62K. What's impressive is that because ETF holders are typically inclined to hold long term, the outflows have been relatively low, even as they move into profit. Although this does beg the question of how much damage this would do to BTC's price once they do decide to start selling. Logically, these outflows would push BTC's price down just as fast as it pushed it up. But, well, let's enjoy this for now and cross that bridge when we get there, eh? The authors then analyze the amount invested into the ETFs relative to the capital inflow into BTC. Between 4 and 5% of the total capital flowing into BTC can be attributed to the ETFs, which aligns perfectly with the amount of BTC held by the ETFs themselves, which you'll recall is also between 4 and 5%. As the authors put it, quote, "This provides a reasonable baseline for evaluating their influence on the market." And next, the authors compare the spot ETFs for Bitcoin and Ethereum. And as you'll know, the demand for the spot Ethereum ETFs has been somewhat lackluster, to say the least. And as such, the inflows and outflows have only managed to move ETH's price up or down by about 1%. Meanwhile, BTC's price is much more affected, which can move up or down by around 8% as a result of ETF inflows and outflows. Now, the next part of the report takes a look at crypto's adoption by assessing the active entities metric, which is a neat little metric that combines any active addresses that could belong to a single entity. The benefit here is that it gives us a much more accurate user count. When the market is in an uptrend, the number of active entities grows in response. Interestingly enough, the number of active entities will also spike when the market capitulates. According to the report, while BTC was chopping sideways throughout the year, there were between 180,000 and 300,000 active entities transacting on the Bitcoin network. What's crazy is that there have been almost 42 million active entities since Bitcoin was first launched back in 2009. While this is impressive, it's also insanely bullish when you consider that 42 million users equates to around 0.5% of the world's population. Of course, this assumes that everyone is self-custodying their Bitcoin. Most people are probably using exchanges as custodians. And if that's you, stop it. Get a hardware wallet. A link to our deals page in the description. And speaking of which, not only does it have discounts on hardware wallets, but also exchange sign-up bonuses of up to $100,000 and trading fee discounts of up to 70%. These won't be available forever, so check that out below pronto. Anyway, another adoption metric is how much daily on-chain volume takes place on the Bitcoin network. According to the authors, quote, On an unfiltered basis, Bitcoin currently sees around 41 billion daily on-chain volume, similar to traditional payment processors like Visa and MasterCard. That's insane. However, the caveat is that word unfiltered. Basically, once you filter out the number of transactions taking place on centralized exchanges, the real volumes are closer to $8 billion per day, which is still pretty damn impressive. For perspective, that's higher than the market cap of every single crypto outside of the top 20. Next, the authors take a look at Bitcoin's realized cap. Now, for those who don't know, realized cap is similar to market cap, except that instead of valuing BTC based on its current price, a realized cap values BTC based on the price of BTC when that Bitcoin was last transacted on-chain. Essentially, this gives you a less volatile picture of BTC's overall value. And as you'd expect, BTC's realized cap has been increasing in recent weeks, suggesting continued BTC buying even at higher prices. And this dovetails with the tokenization of real-world assets, or RWAs, which has been another narrative attracting investors to crypto. And this makes sense considering RWAs consist of assets investors are familiar with, like gold, treasuries, and other securities. As you'll also know, stablecoins have become the backbone for the crypto industry, now being the primary trading pair for most cryptocurrencies and used also as collateral within DeFi protocols. What you may not know is that stablecoins are technically also RWAs, as they're backed mostly by US bonds. In recent months, we've seen the likes of BlackRock and Franklin Templeton dipping their toes into tokenized RWAs, giving them first-mover advantages. And notably, asset managers have adopted the more simplified tokenized treasuries above all other tokenized RWAs, whereas more complicated products have seen much slower adoption. In the next part of the report, the authors take a look at institutional allocators, starting with funding from venture capitalists, or VCs. Despite BTC's ungodly rally to new all-time highs, VC investment has been surprisingly slow, which is in stark contrast to previous bull cycles. If you watched our recent video on the lack of VC investment, you'll know that VC interest today is about as low as it was in 2023, and this is likely because they're waiting for the next big narrative. Spoiler alert, but it won't be the so-called meme coin supercycle. We'll leave a link to that video in the description for you, by the way. Next, the authors turn to the largest publicly traded companies holding BTC on their balance sheets. It comes as no surprise that the company that takes the crown here with well over 270,000 BTC is MicroStrategy, thanks in large part to Michael Saylor's insanely bullish outlook on Bitcoin. Incidentally, we also put out a recent MicroStrategy update, and you can learn more about what Saylor & Co. have been up to using the link in the description, of course. Other listed companies holding BTC include Bitcoin mining companies like Marathon and Riot, and a few companies unrelated to the crypto industry. Although, to be fair, one of these is Tesla, and it's a bit hard to say that it's completely unrelated when its founder and CEO is Elon Musk, the Doge father himself. Anyway, other companies mentioned include Acre, which is an energy services company, and Boya, which is an online gaming company. For anyone wondering, Tesla holds 9,720 BTC, whereas Acre holds 1,170 BTC, and Boya holds 1,100 BTC, at least at the time of shooting this video. What's even more bullish is that tech giant Microsoft also has an upcoming call with its shareholders where they will vote whether it should start holding BTC as well. And if Microsoft adopts BTC on its balance sheet, you can bet your bottom Satoshi that other tech companies will follow suit. The call is scheduled to take place on the 10th of December, by the way, so mark your calendars, guys. Now, in the final section of the report, the authors take a look at where we are in this cycle. But as we said at the beginning, this has become much more obvious now that BTC is rallying like crazy. In a nutshell, the authors explain that BTC experienced a lot of profit taking once it hit its peak back in March and would only enter a stage of euphoria once it broke above that $69K resistance level. Of course, this means that we are now well and truly feeling that euphoria. The authors then assess the annualized volatility of the crypto market, which has been declining with each and every market cycle. On the one hand, this is a good thing, because a key reason why people are put off from investing into crypto is because of how volatile it is and the inherent risks that would bring to their portfolio. Logically then, reduced volatility would mean more adoption and more money flowing into the market. On the other hand, the reduced volatility also results in diminishing returns for each market cycle. Put differently, those crazy 1000x returns are going to be harder to come across, and it's safe to say that those kinds of gains are long gone for BTC and other large cap altcoins. Apologies to any moon boys out there. In all seriousness, the authors provide some stats about the realized volatility for the last 3 cycles. And in case you were wondering, realized volatility is a measure of how much a cryptocurrency's price has actually fluctuated over a given period of time. BTC's realized volatility in the 2017 bull market was between 120 and 150%, whereas the realized volatility in the 2021 bull market was between 80 and 100%. According to the report, the realized volatility for the bull market this year is just between 40 to 60%. And finally, the authors round off this report by looking at a metric called the realized cap hodl waves, which assesses the composition of network wealth. Historically, when BTC hits a cycle top, there is a sharp spike in investor wealth, which makes sense because at that point, pretty much everyone is in profit. As more and more people find themselves in the green, new retail investors on the outside will feel the FOMO and start aping into the crypto market. However, so far this time around, we haven't seen those levels being hit. In other words, this bull cycle is far from over, and if you worried that you missed the boat, this could help put your mind at ease. So then, the big question: what does all this mean for crypto? Well, in case it wasn't already clear, we are right at the beginning of an almighty rally that could take crypto to Valhalla. And given the result of the US election, there's no telling where that rally could stop. Not only do we have a pro-Bitcoin president of the US, which is the world's largest economy, but the Republicans have control of the Senate and the House of Representatives. This means there are now an overwhelming number of pro-crypto politicians across all 3 major decision makers in the US. This all but guarantees that the US will finally introduce positive regulations that will allow the crypto industry to thrive starting in 2025. What's more is that assuming Trump sticks to his promises, one of crypto's biggest obstacles, Gary Gensler, will soon be pushed out of his role as the chairman of the SEC, assuming that he doesn't resign before then. It's fitting that his initials are literally GG. Hopefully, this means that the days of pointless overreach and unclear guidance are finally put in the past. Who knows, we might even finally get to learn what defines a security and a commodity. It goes without saying that this will bring more legitimacy to the crypto industry, which will attract new investors to the space, particularly the more traditional investors who would normally rather play it safe, so to speak. And this is especially true when you consider that BTC is now in price discovery mode, which is blowing up everyone's portfolio like a balloon. It's only a matter of time before outsiders want a piece of that action and start going further down the risk curve. And this is where you guys have already won the game. You've managed to front run every single one of them, especially when it comes to altcoins. And that's because once BTC tops out, investors will start the great rotation into alts in order to maximize their gains. The fact that nobody believes it's going to happen is just evidence of the fact that if you're watching this, you're early. As Bitcoin dominance floats around 60% at the time of shooting, it may be a good idea to start planning your altcoin rotation. Not financial advice, of course. Okay, that's all for today's video, guys, but I'd love to get your feedback. So let me know down in the comments, where do you think Bitcoin is going in the next few months? And of course, if you enjoyed this video, you know what to do. Smash that like button, subscribe button, and bell icon too. And if there is someone you know who would benefit from this video, well, why don't you take a second to share it with them? As always, thank you very much for watching, and I'll see you in the next one. This is Nick, signing off.